Hello, ladies and gentlemen. I hope you're fine wherever you are. I am the Acca tutor, Mr. Jeremy Chimkulu. In this video, I'm going to take you through the process of computing goodwill as it relates to the business combination in terms of International Financial Reporting Standard number 3. Okay, so you will see as we proceed that there are two methods of calculating goodwill. We've got the proportionate method and the full goodwill method. The proportionate method is actually the traditional way of measuring goodwill, where goodwill is measured on acquisition, that is when control is achieved, as the excess of the fair value of the consideration given by the parent over the parent's share of the fair value of the net assets acquired. So this method can be referred to as the proportionate method. Alright, so that's the proportionate method. It determines only the goodwill that is attributable to the parent company. Now, when we are talking of the full goodwill method, here, this is another method of measuring goodwill on acquisition of a subsidiary, where we have to compare the fair value of the whole subsidiary, which means we are referring to the consideration transferred plus the NCI of the subsidiary. Okay, so we have to combine this whole thing, the consideration and the NCI, and then we compare the total with the net asset, the fair value of the net assets of the subsidiary which has been acquired. Okay, the net assets of that subsidiary which we would have acquired. So this method can be referred to as the gross or full goodwill method. It determines the goodwill that relates to the whole of the subsidiary, that is goodwill that is both attributable to the parent's interest and that of the NCI. So there is this tablet, ladies and gentlemen, I want you guys to appreciate. Okay, when we are talking of the full goodwill method, all right, like I said, we have to combine the consideration transferred. Okay, the consideration transferred, this is the fair value of consideration transferred, and the fair value of the NCI. Okay, let's say we have acquired an 80% stake in a company, so that's an 80% subsidiary. So when we are calculating the goodwill on acquisition, we say fair value of the consideration transferred, which is 80% plus the 20% NCI, and we get the 100%. Okay, and then we say the fair value, we deduct the 100% of the fair value of net assets. All right, and we arrive at the goodwill. Okay, but if we are using the partial goodwill method, we are going to say, let's say we have acquired again an 80% subsidiary. Okay, we say the fair value of the consideration transferred 80%, and then the fair value of the net assets transferred only the 80% net asset value, and then we arrive at an 80% goodwill. That's our goodwill, ladies and gentlemen. Remember, we are not going to affect the NCI with this type of goodwill. Okay, because when we are using the proportionate share, the proportionate basis, the standard requires us only to consider whatever impairment that happens to have occurred to the parent and not affecting the NCI. Okay, so I think we should have an example for us to illustrate this point clearly. So ladies and gentlemen, let us move on to this particular example where we are having Bolton, which has acquired 80% interest in the equity shares of Hiba for consideration of $500. The fair value of the net assets of Hiba and the debt is $400. The fair value of the LCI at that date, that is the fair value of Hiba's shares not acquired by Bolton, is $100. Now we are required to calculate the goodwill arising on the acquisition of Hebel. Okay, we are arose on the acquisition of this company using the proportionate basis. Right, that's our first point of call. So we say that goodwill is the fair value of consideration transferred, and I said uh, this value is actually the cost of the shares acquired. All right, and then we say, because we are using the proportionate basis, we actually have to go. All right, this is actually deemed to be the 80% amount, or it's considered the 80% consideration. All right, all right, you will see, and then we say less uh, uh, the group's share of net assets. Okay, that is the parent share of net assets. Parent share of net assets. Parent share of net assets at acquisition, and we are saying we have purchased 80%. So what was the net asset? The net assets of Hebel on this particular date was 400. So we say multiply by $400, and we should get our 320. So this is deducted from the 500, and we must get our 180 as the goodwill attributable to the parent. Goodwill attributable to the parent. So that's the proportionate basis, ladies and gentlemen. But when you are using the full goodwill method, we are going to do a slightly different thing, but we'll be doing the same thing, because by the end of the day we'll be calculating the goodwill. So the full goodwill, we start again with the fair value of consideration transferred, and we are told this was $500. Okay, but we are also told that the NCI at this particular date was $100. So we are going to say NCI at acquisition $100. Then we are going to deduct less net assets at acquisition. Okay, here we are not going to apportion, we are just going to take the whole 100%, which was 400. Okay, 400. Sorry, with my pen. Okay, and we get our $200 as goodwill. Okay, all right, so that's how you are going to do your computation for the goodwill. Remember, this goodwill is actually considered gross. Gross. It includes the parent and the NCI element. They are both included there. All right. So in cases where there is some impairment, the impairment loss is going to affect both the parent as well as the NCI. If we are talking of the full goodwill. All right. Sometimes the goodwill is a negative figure. All right. Sometimes the goodwill is a negative figure. When it is negative, okay, when the goodwill is negative, we consider it's a bargain purchase. Okay, we consider that one a bargain purchase. All right. How do we treat this one? This is treated as income. Okay, you have to treat it as just income. It's some gain. All right, would have made some gain. All right, that would be some gain. Okay, so far the goodwill has been positive, which means that it is considered as the premium which arise on acquisition. Okay, there's been some premium paid by the company during the acquisition. Okay, there's some premium, so it is considered as an intangible asset in the statement of financial position, the group statement of financial position. All right. However, this goodwill, positive goodwill, which we would have determined, is actually subject to an annual impairment review. All right. So every year, the company, the directors are put to task to consider whether the goodwill has been subject to impairment. All right. There are several indicators for impairment which could be considered. For example, the subsidiary is operating in an environment where the legislation has been put there which restricts its performance, or some of its major machineries or suppliers have been declared bankrupt, so that subsidiary is not going to operate as it should be. Then you could say that there are some indicators of impairment. All right, but that's a meal for another day. Let us continue with our exercise. We want to know how to compute goodwill, and we have done the basics. Now let us consider when the goodwill has been impaired. All right, the definition of impairment is just the usual definition in terms of International Accounting Standard number 36, impairment of assets. All right. So the impairment of goodwill, like I said, goodwill is an intangible asset. Okay, it is considered an intangible asset under the non-current assets of the business, the statement of financial position. All right. So an asset is impaired when its carrying amount exceeds the recoverable amount. The carrying amount is the balance sheet figure as reported by our records. Okay, our records are saying that the goodwill is 3 million. Okay, that's the carrying amount. However, the recoverable amount is something else. The recoverable amount is defined as the higher of the fair value less cost to sell. The higher of fair value less cost to sell. Okay, fair value less cost to sell, and the value in use. Okay, value in use, where the value in use is the present value of the future cash flows. All right, so this one has to do with the future cash flow. Now this one has to do with the issue of disposal of the asset. Okay, let's say we want to dispose of the asset today. What is the price are we likely to get on a willing buyer, willing seller basis? All right, what are we going to get if we sell it today? What are we going to charge for? What are we going to get? All right, so we are saying the recoverable amount is the higher of this one and this one. Whichever is higher is our recoverable amount. So in the exam, you might be asked to identify the recoverable amount given the fair value less cost to sell, or the value in use, or the carrying amount. All right, so you can see that the carrying amount would be actually out of question, but you need then determine which one is the higher between the two. All right, and that will be the recoverable amount. Okay, now let us now consider the impairment issue if we are using the full goodwill method. All right, the subsidiary is treated as a cash generating unit where the carrying value is that of the subsidiary plus n goodwill. Okay, so we have got example Dewa here. All right, Dewa acquired 60% of the equity share capital of RAI on 1 January 2015 for 20 million. So we can see that this was the fair value of the consideration transferred, which was 20 million. The fair value of the identifiable net assets at that date was 25 million. The fair value of the non-controlling interest was 15 million. Farai made profits for the year ended 31st December 2015 of 5 million. Its value in use was calculated as 38 million and its fair value less cost to sell was 36 million. All right. Calculate the impairment in the subsidiary to be recognized in the financial statement of Dewa as at 31st December 2015. So we have that information, ladies and gentlemen. You just have to calculate your traditional goodwill, your ordinary goodwill, okay, before you worry about whatever impairment that is going to be there. So let us get straight to our drawing board. Okay, so we say fair value of consideration transferred, and we are told that this was in millions, so we paid almost about 20 million, so that's 20,000. All right, and we are using the full goodwill method, so we just have to add NCI, fair value of NCI fair value, okay, at acquisition. And we are told from the question this was how much? 15 million. Okay, and then we have to deduct fair value of net assets at acquisition. From the question, the net assets were valued at 25 million. So we get our goodwill at acquisition of how much? 10 million. Okay, now this is the fair value of goodwill at acquisition. All right. Okay, now given our the goodwill at acquisition, this is the rough spelling of goodwill. All right. Okay, we then have to come back to this particular statement where we say that the subsidiary is considered the cash generating unit where the carrying value is that of the subsidiary plus n goodwill. Okay, so let us determine the carrying value at the end of the year. Okay, the carrying value of the subsidiary. Okay, carrying value of sub of the investment in this subsidiary is equal to the fair value of our net assets at acquisition, okay, net assets at acquisition plus any post-acquisition profit. Post-acquisition profit, okay, and any goodwill which we have, okay. So this gives us our net assets has been 25 million as we have determined here. So that's 25 million plus any post acquisition. From the question, we are told that Farai made profit for the year ended 31st December 2015 of 5 million. Okay, so that was the post acquisition profit, okay, 5 million plus any goodwill which Farai had at acquisition, and this goodwill has been 10 million. So it means the carrying value was 40 million. All right, now we are having the carrying value of 40 million, and then we are also told that the carrying value, the recoverable amount, its value in use was 38 million and fair value less cost to sell was 36 million. So obviously the recoverable amount here is 38 million, okay. The recoverable amount is actually 38 million, which is the higher. All right, so we are going to say recoverable amount is 38 million, which was the higher of 38 and 36. All right, so this means the subsidiary has been impaired because the carrying value of 40 is higher than the recoverable amount of 38, as you can see here. So the impairment loss or the impairment is actually the difference, which is equal to 2 million. Okay, ladies and gentlemen, the trick bit is just to determine the recoverable amount, and the recoverable amount is the higher of the fair value less cost to sell and the value in use. As you have seen here, the value in use was 38 million and the fair value less cost to sell was 36 million. So you pick the larger number, which was the value in use, okay, and you put that one. Okay, that's how, and this was the full goodwill method, which means both the NCI and the parent are going to be affected. The impairment is going to be shared. There is share of impairment loss, which is going to affect the retained earnings of the parent, as well as the share of impairment loss that is going to affect the non-controlling interest. So when you are doing your computation for the NCI, for the group, consolidated financial statements, then you are going to put into consideration the impairment. So that is what is happening. So in short, we are simply saying the applicable journal entry. Okay. Okay, the applicable journal entry is going to be we are going to say debit the retained earnings, okay, with the parent share. If it was a 80% subsidiary, then we just say 80% multiplied by the impairment loss, that is 80% multiplied by 2 million, Okay, and you get the figure. All right, and we are also going to debit the NCI. All right, remember our NCI working, the NCI working with the NCI share of that 2 million, and then we are going to credit. What are we going to credit? We're going to credit the goodwill, because goodwill is an asset. So when we are crediting the asset, we are reducing the goodwill. Okay, and here we are crediting the goodwill with the 2 million itself. Okay, with the 100% share, we are deducting 100% from the goodwill of the impairment. 100% of the impairment. We are crediting goodwill with the 100% of the 2 million. All right. However, when we are debiting, we are going to apportion according to the control, the shareholding. Okay, that was that for the full goodwill method. Let us now do the last bit, that is the partial goodwill method. Okay, the partial goodwill method. If goodwill is measured using the proportionate share method, the goodwill calculated consists of the partial goodwill, that is the parent share, and the impairment is allocated entirely to the group retained earnings, as there is no NCI share of goodwill. The calculation of the impairment becomes slightly more complex, as the carrying value of the subsidiary needs to reflect the net assets of the subsidiary plus the full goodwill, as the recoverable amount used is that of the entire subsidiary. The issue is that the goodwill figure reflects the partial goodwill. Okay, that is only the parent share and not the full goodwill. So the partial goodwill will therefore need to be grossed up to an equivalent full goodwill amount, so that the impairment is calculated on the full value of the subsidiary, that is subsidiary's net assets plus grossed up goodwill. The carrying value can then be compared to the recoverable amount as normal to calculate the impairment. Please note that the grossing up is only for the purpose of the calculation of the impairment. Outside that, you do not have to do that. So the grossing up is not recorded in the ledger or the financial statement. This is just a background computation. It is a background or a back office computation. All right. So let us look for a very applicable example to illustrate this point. Okay. Ladies and gentlemen, we are at this particular example here. At the year end, an impairment review is being conducted on a 6% owned subsidiary. At the date of the impairment review, the carrying amount of subsidiary's net assets were 250, and the goodwill attributable to the parent was $300, and the recoverable amount of the subsidiary was $700. Determine the outcome of the impairment review. Okay, gentlemen, here we have been told that this was a 60% subsidiary, and we know that when you are using the proportionate goodwill method, the goodwill is only attributable to the parent and not to the NCI. So basically, the calculations which led to the determination of this goodwill was like this. Okay, I'm trying to reconstruct the computations which were done. That's fair value of consideration was X. Okay, and this X was only 50%. Okay, less and net assets share. Okay, which was X, and it was also 60%. All right, that was the share of net assets which was considered, and we determine goodwill, and this goodwill was also 60%. All right, and in this case, the goodwill was actually the goodwill was $300. All right. All right, whatever figure that took place there, we ended up having $300. Okay. Now, at the end of the year, all right, at the end of the year, an impairment review was done. Remember, we said that goodwill is an intangible asset which is subject to an annual impairment review. All right. So, at the end of the year, there was an impairment review, and this review determined that the subsidiary's net assets were $250 and the goodwill was $300. All right, we know that. Fine. The recoverable amount was $700. Okay, so because we are using the proportionate goodwill method, you don't just have to rush and use the formula for determining the carrying value of the asset, because remember, in this case, the carrying value of the subsidiary here has to be based on the full valuation basis. All right. So we need to gross up to bring the goodwill to the full subsidiary perspective, okay, to full goodwill level. All right. This goodwill we are seeing here is only for the parent. We are not having the goodwill for the NCI, so we have to determine that notional goodwill for the NCI. All right. So we have to do some bit of computation. How do we gross up? Let us have this decent table. All right, the proportionate goodwill. Don't mind my spellings. I'm a poor guy when it comes to spellings. Please forgive me. Let me just try to use a different pen. All right, let me just try to use this one. Okay, the proportionate goodwill. This was, according to the question, it was 300. Okay. Okay, it was 300. Fine, but we have to actually gross this up. Okay, we know that this was a 60% subsidiary, so the grossing up we should say 100 over 60. All right, we want to bring this goodwill to 100% level. Okay, so we then have to have our goodwill, including notional and recognized NCI. Okay, and if we do our computation very clearly and very well, we know that 60 into 300, this should be 5, and 5 multiplied by 100, we should get our $500. Okay, so that's the goodwill, or actually the notional goodwill, all right, which we have determined. This is only for the impairment review purposes only. All right, so for our purpose for impairment review, the goodwill of 500 plus the net assets of how much for the net assets of the subsidiary were 250. So we can now, at this level, we can now use the original formula now, that the carrying amount of the subsidiary is equal to the net assets of the subsidiary plus any goodwill plus any post-acquisition profit whatsoever. And here we have, we need not to worry much about the post-acquisition profit. We are not given that information, so we just have to use the figures we have at hand. So we are having the net assets of the subsidiary, which was the net assets plus goodwill, right? So we are saying the net assets was 250 plus the notional goodwill, which we have just determined, is 500. Okay, so the carrying amount obviously becomes $750. But we are told that the recoverable amount, let me just put it in a box. Recoverable amount was how much? According to the question, the recoverable amount was 700. And we are saying impairment is a situation where the carrying amount exceeds the recoverable amount. So the books are showing that our asset, the subsidiary, is worth $750, but the actual situation on the ground, the recoverable amount, is showing that we are $700 worth. So this means that impairment is about 750 minus 700, and this gives us $50. That's the impairment loss. Okay, impairment loss. Now the situation is, how do we then treat this impairment loss? Because in the situation of a full goodwill analysis or full goodwill method, we allocated the impairment loss between the parent and the NCI. But in this case, the impairment loss is not going to affect the NCI. So how do we proceed from there? So only the parent is going to be affected. So if that is the case, let me just write this poll. Only the parent is affected. Okay, so at what level is it affected? 60% multiplied by 50, that is $30. All right, is going to be deducted from the parent's retained earnings. Okay, the retained earnings are going to be reduced by that amount. Okay, but now in the statement of financial position, again, the goodwill is going to be reduced. Okay, the impairment loss will be applied to reduce the goodwill, all right, or to write down the goodwill, so that the intangible asset of goodwill will appear with a lesser amount. So in SFP, okay, intangible asset goodwill will appear as $300 minus 30, which comes to 270. Okay, that is what is going to happen. All right, that's the group statement of financial position. All right, what about the RRE, the retained earnings, the group retained earnings? The group retained earnings are going to be reduced by 30. But there is no impact on NCI. Okay, in the statement of profit or loss, there is going to be an extra consulting expense of $30, but no impact on NCI. So in the group statement of profit or loss, okay, there is going to be an extra expense of $30. All right, this is going to affect the group only, the parent only, but not the NCI. Okay, so that's what happens, ladies and gentlemen, and I hope you have been treated very, very nice. Okay, if you wish, we can get along. We can be in a tutor student relationship. Please feel free to contact me on +263 774 596 368 or visit my website at www.transcarconsulting.co.zw or just click the like button. Okay, like button. Subscribe. Okay, please subscribe to my channel. Just subscribe, and also please don't forget to share. Just share the video with your friends, with anybody, so that they also get assisted. Remember, by the end of the day, everybody should be a professional accountant so that we live in a better world. Alright, until next time, please feel very, very excited. Thank you.